Your worst breakout loss probably began at the exact moment you felt safest. Price cleared the level, momentum appeared, and the chart seemed to confirm what you had been waiting to see. You entered because hesitation now felt more dangerous than action. Then the move failed, and what looked like strength became a trap with remarkable speed. The uncomfortable truth is that price crossing a level is not the same as price being accepted beyond it. A breakout is an event. Acceptance is a process. When you confuse the two, you commit capital to the first visible signal while more patient traders are still studying the response. A market often moves beyond an obvious high or low because that is where orders are concentrated. Stops are triggered. Breakout entries arrive. Traders who feared missing the move finally participate. This sudden activity may create real continuation, but it may also provide liquidity for larger sellers or buyers waiting on the other side. The same candle can therefore represent strength to one trader and opportunity to exit to another. That is why a fakeout should not be judged by the level alone. You must observe what the market does after the level is crossed. Does price remain outside the range or return immediately? Do subsequent candles build on the move or struggle to make progress? Does increased activity produce distance, or does the market absorb that effort without advancing? Effort without progress deserves your attention. Suppose, hypothetically, price breaks above resistance on a wide candle. The inexperienced eye sees the size of the candle and calls it conviction. A more careful eye watches the close, the next reaction, and the behavior near the broken level. If buyers were truly in control, they should be able to defend at least part of the ground they gained. If they cannot, the breakout has revealed something, but perhaps not what the crowd believes. Your task is not to predict every trap before it occurs. Markets are uncertain, and no observation removes risk. Your task is to stop treating excitement as confirmation. Avoid entering merely because price has reached the place where everyone was taught to act. Notice whether the move is being sustained, whether rejection appears quickly, and whether trapped traders may soon be forced to reverse their decisions. This change in attention is small, but its implication is serious. The best clue may not be the breakout itself. It may be the sequence of behavior surrounding it. The pressure before the level breaks, the quality of the move through it, and the market's first response once the obvious orders have been triggered. A chart makes a breakout look like a clean event. There is a line, price moves through it, and the eye immediately divides the market into before and after. But the market does not recognize your line as a verdict. It recognizes only transactions, and one transaction beyond a boundary proves nothing more than the fact that someone was willing to trade there. This is the first distinction you must hold firmly. A break describes location, acceptance describes agreement. A break tells you where price reached. Acceptance tells you whether the market is prepared to conduct business in that new area. Those are different pieces of information, yet they are often treated as if they were the same. Consider what a level actually represents. It is not a wall built into the market. It is a reference point created by earlier decisions. Traders remember it, place orders around it, and use it to judge whether price is expensive or cheap. When price crosses that reference, the crossing challenges the old judgment. But a challenge is not yet a change. For acceptance to exist, the market must begin treating prices beyond the boundary as ordinary rather than exceptional. Buyers and sellers must both become willing to transact there. This may sound strange because a bullish move appears to require buyers alone. In reality, sustainable trade also requires sellers who are comfortable offering stock, contracts, or currency at the new prices. Without the two-sided willingness, price has visited a new area without establishing it as meaningful territory. This changes how you interpret the breakout signal. If you see the cross itself as confirmation, your decision becomes mechanical. Below the level means no trade. Above it means trade. That simplicity is appealing, but it gives a single print more authority than it deserves. Markets rarely change condition merely because a line has been touched from the other side. The better question is not, did price break the level? The chart already answers that. The better question is, has the market's judgment of value changed? That question forces patience because value cannot be established by appearance alone. It must be demonstrated through behavior. Before the trade, decide whether you are acting on penetration or waiting for acceptance. Do not change that standard simply because the move looks persuasive in real time. If your plan requires acceptance, then the first cross is information, not permission. You observe it without granting it a meaning the market has not yet earned. It also helps to stop thinking of important levels as exact prices. Treat them as areas where the market must make a decision. An exact line encourages you to react to a fraction of movement. An area encourages you to judge whether the old boundary is genuinely losing its influence. This keeps your attention on the change in market condition rather than the drama of a single moment. Once you begin separating location from agreement, another question appears. How much work did the market have to perform to move beyond that boundary, and what did it actually gain from the effort? A market can appear powerful while accomplishing very little. Price surges, pauses, surges again, and the movement looks aggressive. Yet after all that activity, the actual distance gained is small. The eye notices the force, the disciplined trader measures the result. Effort matters only in relation to what it produces. When buyers press hard and price advances easily, opposition is being cleared. When the same pressure produces less movement, someone is meeting that demand. The weakness is not that buyers have disappeared. The weakness is that their buying no longer has the same effect. This is an important distinction because visible activity can hide declining control. A side may still be attacking while losing its ability to move the market. Each attempt uses orders, attention, and commitment. If repeated attempts gain less ground, the campaign is becoming less efficient. What looks like persistence may actually be exhaustion developing beneath the surface. The market often reveals opposition indirectly. You may not know who is selling or why, but you can see the consequence. Upward pushes become crowded. Movement overlaps. Ground that once required little effort now requires repeated pressure. Cause is increasing while effect is shrinking. That imbalance should make you cautious. Strength is not measured by noise, speed, or the emotional force of the move. It is measured by how readily price responds. If a market must work unusually hard for a modest advance, then the path ahead is not as open as it appears. Consider a hypothetical sequence in which price makes 3 upward drives. The first travels a clear distance. The second covers less ground. The third is energetic but barely extends the move. Viewed separately, each drive may look bullish. Viewed as a sequence, they reveal deteriorating efficiency. The same kind of action is producing a weaker result. This does not prove that price must reverse. Markets can pause, rebalance, and then continue. Effort without progress is evidence, not certainty. Its value is that it warns you against assuming that aggressive movement automatically means control. You are reading the relationship between action and outcome, not predicting from appearance alone. In practice, compare each push with the one before it. Notice how much distance is gained, how directly it is gained, and how much overlapping movement is required. A clean advance uses little visible struggle. A doubtful advance keeps spending energy in the same area without receiving much in return. You should also separate persistence from effectiveness. Traders often admire repeated attempts because they seem determined. But the market does not reward determination. It responds to imbalance. If effort rises while progress contracts, the attacking side may be supplying the very activity needed for stronger opposition to operate. The question then changes. You are no longer asking whether buyers or sellers are active. You are asking whether their activity still moves price efficiently. That comparison can expose weakness before the direction itself becomes obvious. But if heavy effort is being absorbed near a place everyone can see, another matter must be examined. Why price was drawn into that territory, and what orders may be waiting just beyond it. The clearest price on your chart is often crowded with orders you cannot see. An obvious high, low, or range boundary attracts attention because different traders make decisions at the same location. Their reasons differ, but their orders gather together. That concentration makes the level useful to anyone who needs a large number of willing counterparties. Consider what may sit above a widely watched high. Short sellers may place protective buy orders there. Momentum traders may leave conditional orders to buy if the high is exceeded. Other participants may delay decisions until that same price is reached. While price remains below the high, these orders are inactive. The moment the level trades, they can become immediate demand. This sudden demand creates liquidity. A participant seeking to sell a large position cannot simply press a button without consequence. Selling requires buyers on the other side, and a cluster of activated buy orders provides them. The area above the high may therefore be attractive, not because the market intends to continue higher, but because business can be completed there. This does not require a hidden operator controlling every movement. Markets naturally move toward places where orders are available. When thousands of independent decisions collect around the same reference, the resulting order pool can influence price without any coordinated plan. Structure alone is enough. A liquidity trap forms when the burst caused by those activated orders is mistaken for fresh directional conviction. The movement appears meaningful because it is sudden, but part of that urgency may have been scheduled in advance. The orders were waiting for price. They did not necessarily arrive because new information changed the market's outlook. Imagine, hypothetically, 3 nearly equal highs. Each failed attempt encourages more short positions beneath them, while also attracting traders who plan to buy the eventual breakout. Above the highs, protective orders and entry orders begin to occupy the same narrow area. When price finally reaches it, both groups buy for different reasons. Their combined demand creates a sharp upward release, and, at the same moment, gives prepared sellers the buyers they require. The implication is subtle. A forceful move through an obvious level may tell you that liquidity was found. It does not, by itself, tell you whether the move has lasting sponsorship. Intensity can come from the concentration of orders rather than from a durable change in conviction. Before price reaches a major reference, map the orders that are likely to surround it. Look for equal highs, equal lows, clear range edges, prior session extremes, and swings visible on several common chart views. Then ask a practical question. Which traders will be forced or triggered into action if that price trades? Above an obvious high, the urgent side is commonly the buyer. Below an obvious low, it is commonly the seller. That matters because urgent orders are willing to accept less favorable prices. They value execution over precision, which makes them useful counterparties for participants positioned in advance. Do not assume every move into liquidity must fail. Genuine trends also pass through crowded levels and continue. The purpose of this reading is narrower. It prevents you from treating the release of pre-positioned orders as complete proof of direction. First, understand why the sudden activity occurred. Only then judge what it accomplished. Once that pool of orders has been reached, the extreme price tells only part of the story. The next clue lies in where the breakout period finally leaves the market, and what that closing location quietly reveals. The most dramatic point of a breakout candle is often its least reliable feature. Your eye is drawn to the furthest price reached, because that is where the move looked strongest, but the extreme records only a moment. The close records where the contest stood when that period ended. Every candle contains 2 different stories. Its high and low show the full territory explored. Its close shows the price the market was able to preserve. A market may travel far during the interval, but if much of that distance is surrendered before the candle finishes, the final condition is weaker than the early movement suggested. This is why candle size alone can mislead you. A wide bullish candle may appear decisive, yet its meaning changes if it closes near the middle of its range rather than near the top. The distance traveled was the same, but the distance retained was not. Control is better judged by what remains after opposition has had a chance to respond. The close should also be read in relation to the broken level. For an upward breakout, a close clearly beyond the boundary shows that buyers preserved the breach through the end of the period. A close barely above it shows a less decisive result. A close back beneath it shows that the market crossed the boundary but could not finish there. These are not identical outcomes, even if all 3 candles printed the same high. The extreme may make them look similar on a quick glance. The closing location separates them, because it shows how much authority the breakout side still possessed at the final transaction of that interval. There is another detail traders often overlook. A close has meaning only within the time frame being traded. A 5-minute candle records a 5-minute contest. A daily candle records a full session. Neither is automatically superior, but the evidence must match your decision horizon. If your trade depends on a daily break, an intraday close cannot settle the question for you. You can make this reading more precise without adding complicated indicators. Divide the breakout candle mentally into thirds. For an upward break, a close in the upper third suggests that most of the advance was preserved. A close in the middle third shows a mixed result. A close in the lower third reveals that much of the move was surrendered. For a downward break, reverse the logic. Then compare the close with the breakout boundary. Its position within the candle tells you how the period finished internally. Its position relative to the level tells you whether the breakout itself remained intact at that moment. Using both prevents a strong, looking candle body from hiding a weak final location. The shape of the upper or lower shadow adds context, but the shadow should not be judged by appearance alone. Its importance comes from the distance between the extreme and the close. That distance represents territory reached, but not retained. The larger that abandoned portion becomes, the more carefully you should question the apparent authority of the move. If your method depends on closing evidence, do not make the decision while the candle is still forming. An unfinished candle can display strength that disappears before the interval ends. Waiting does not remove uncertainty, but it prevents you from treating a temporary price as a completed result. Still, one strong close proves only what happened during one measured period. The next test is whether the market can build upon that result, or whether the breakout begins to fail as soon as a new candle takes control. A breakout creates an obligation. If the move reflects genuine directional pressure, the market should begin producing fresh territory. When that expansion does not appear, the absence itself becomes evidence. This principle is easy to overlook because traders concentrate on what happened during the break. They study the initial surge and assume its force will continue. But the bars that come afterward answer a different question. Did the breakout change the market's direction, or did it merely interrupt the prior condition? Real continuation has a certain logic. Once a boundary is cleared, traders who were waiting for confirmation may participate, while those opposing the move may become less willing to stand in its path. Because one side is pressing and the other is yielding, price should be able to extend. If it cannot, then the apparent advantage was less durable than it looked. Failed follow-through often begins quietly. The next advance adds almost no new ground. Another attempt remains inside the area already covered. The bars begin to overlap, and each push is partly erased before the next one begins. Nothing dramatic is required. The warning lies in the market's inability to continue doing what the breakout implied it was ready to do. This is negative evidence. The failure of an expected event to occur. Traders often wait for a clear reversal signal because they want the market to announce that the breakout was false. Yet the earlier clue is frequently simpler. The expected continuation never arrives. A healthy move should not need constant explanation for why it has stopped advancing. One weak bar is not enough to settle the matter. Markets pause even during strong trends. The distinction lies between a temporary pause and repeated failure. A pause interrupts progress. Failed follow, through repeatedly attempts progress and cannot create it. The first preserves the directional structure, the second gradually undermines it. To apply this, define your continuation expectation before the breakout occurs. Decide what meaningful extension would look like on the time frame you trade. It may involve fresh highs after an upward break, fresh lows after a downward break, and a general shift of successive price ranges in the breakout direction. The standard should fit the instrument rather than an arbitrary number of points. Then read the succeeding bars as a sequence, not as isolated shapes. Ask whether the market is expanding into new ground or recycling the same ground. Notice whether directional attempts add meaningful distance or merely redraw territory already covered. The more often price must restart from the same area, the less authority the original break retains. This reading also protects you from adding to a position for the wrong reason. A trader who has already committed may interpret every pause as preparation for another surge. But additional exposure should require additional evidence. If the market has stopped confirming the original idea, increasing commitment only enlarges dependence on an unproven outcome. Failed follow through does not automatically mean an immediate move in the opposite direction. It means the breakout thesis has lost an important piece of support. The proper response is to downgrade the signal, not to manufacture certainty on the other side. When expansion fails, price often drifts back toward the boundary it crossed. That return creates a more direct examination of control, because the first retest forces buyers and sellers to defend the level rather than merely pass through it. The first return to a broken level is where a breakout must defend its claim. Passing through a boundary shows that one side could advance. Meeting that same boundary from the opposite direction reveals whether control has actually changed hands. Before an upward break, resistance is an area where sellers have repeatedly stopped buyers. After the break, the old resistance is expected to serve a different function. Buyers who believe the market has shifted should be willing to act near that area, while sellers should find it harder to push price back into the former range. The downward case follows the same logic in reverse. This change of function is often called role reversal, but the name can make it sound automatic. It is not. A line does not become support simply because price moved above it. The market must prove that participants now behave differently when the area is revisited. The first retest is especially revealing because the original contest is still fresh. Decisions made during the breakout have not yet been diluted by many later swings. The market is returning to the scene with the new directional claim still under examination. What happens there gives a cleaner reading than a level that has already been tested several times. A useful retest does not require an exact touch. Important levels usually operate as zones because orders are spread across nearby prices. If you demand perfect contact with a single line, you may misread a valid defense as an incomplete test. The question is not whether price touched your drawing. The question is whether the market respected the area. For an upward breakout, a constructive retest remains largely above the former ceiling and establishes a new turning point near it. Buyers do not need to prevent every small penetration. They need to prevent sellers from restoring the old range as the dominant area of trade. For a downward breakout, sellers must perform the corresponding task beneath the former floor. Depth matters because it reveals how much of the breakout structure is being surrendered. A modest pullback toward the boundary can be a normal examination. A return deep into the old range challenges the entire premise, because price is no longer testing the edge, it is undoing the separation created by the break. The shape of the resulting swing matters as well. If the retest holds, the market should leave behind a clear structural point from which the breakout direction can resume. That point becomes evidence that one side defended the new territory. Without such a point, you may be assuming control before either side has demonstrated it. In practice, mark the full breakout zone before the retest begins. Set its width according to the instrument's normal movement rather than choosing a convenient number afterward. Then define 3 possible outcomes: respect above the zone, partial penetration with recovery, or full restoration into the prior range. This keeps your reading tied to observable structure. Avoid treating the first touch as an automatic entry. The retest is a test precisely because its outcome is not known in advance. Let the interaction show whether the old boundary has changed function. If you act before that evidence develops, you are trading the location of the test rather than its result. Yet price structure reveals only one side of what occurred during that retest. To understand whether the defense was genuine or merely appeared stable, you must next compare the amount of participation with the amount of movement it produced. Volume is often treated as if it were a vote for direction. A breakout occurs on heavy activity, and the move is called confirmed. But volume does not tell you which side is right. It tells you only that a large amount of business was completed. Every transaction contains both a buyer and a seller. What moves price is not the existence of trades, but the ability of aggressive orders to consume the orders resting against them. If buyers keep lifting offers and price travels upward, the available supply is being cleared. If the same buying produces little expansion, supply is being replaced fast enough to contain it. This is absorption. One side acts aggressively, but the other side quietly accepts the flow without giving up much ground. The aggressive side is easy to notice because it initiates the transactions. The absorbing side is less visible because it waits. Yet the waiting side may be controlling the area precisely because it can handle repeated orders without allowing price to escape. At an upward breakout, unusually high volume within a narrow extension can mean that buyers are active, but it can also mean that sellers are providing everything those buyers demand. At a downward breakout, heavy selling may be met by buyers willing to absorb the supply. The histogram shows the exchange. The limited expansion reveals the resistance within that exchange. Imagine, hypothetically, a futures contract moving above a recent high. Turnover becomes unusually heavy, but price adds only a small amount of new territory. A trader looking only at volume sees strong participation. A trader comparing volume with displacement sees something more important. A great deal changed hands without forcing the auction much higher. That condition does not identify the final direction by itself. Absorption can precede a reversal, but it can also end when the resting orders are finally exhausted. The information is narrower. The aggressive side has not yet proved that it can overwhelm the opposition. High activity has exposed a contest, not settled it. Volume must also be judged relatively. Activity naturally changes across instruments, sessions, and times of day. The opening of a major session should not be compared carelessly with a quiet midday period. Compare the breakout with recent periods that share similar conditions, or ordinary volume may appear exceptional simply because the context changed. Then compare participation with movement. You do not need a complicated formula. Ask how much new distance was created for the amount of trading that occurred. Rising volume with expanding range shows that transactions are moving the auction. Rising volume with contracting range shows that more business is producing less displacement. Heavy turnover concentrated in one narrow area points toward absorption. This prevents a common analytical error calling volume confirmation without asking what it confirmed. High volume confirms interest. It may confirm conflict. It may confirm that ownership is changing rapidly. Directional control requires evidence that the activity can actually carry price away from the contested area. When you see exceptional volume without expansion, mark the area rather than declaring a winner. Observe which side is initiating and which side appears able to absorb. Until the balance breaks, the volume is warning you that substantial opposition exists where the breakout was expected to move freely. And once that balance finally gives way, the next clue comes from the traders who committed during the struggle, because some of them will discover that the market has left them on the wrong side. A trader becomes trapped before the position is closed. The trap begins when the reason for entering has been damaged. The market is moving against the position, and a large group now depends on the same recovery that may never come. Being wrong and being trapped are not identical. A position can move temporarily against a trader while its original structure remains valid. A trapped position is different. The market has contradicted the entry premise, yet the trader has not acted. That unresolved position becomes potential order flow. This matters because every position must eventually be closed. A trapped buyer must sell. A trapped seller must buy. If many traders entered from the same visible signal, their eventual exits may be concentrated in the same direction. Before those orders reach the market, you can often locate the pressure by identifying where the positions were likely opened. Start with the breakout entry band. This is not a precise price, but the area where the signal became convincing enough to attract action. Traders who entered there share a similar cost basis. Once price moves back through that band, their positions begin to carry both financial pressure and a damaged thesis. The next area to mark is the point where the breakout idea becomes difficult to defend. For an upside break, that may be the portion of the former range that should not have been recovered by sellers. For a downside break, it is the corresponding area above. When price reaches that zone, the crowd is no longer dealing with an ordinary fluctuation. It is confronting evidence that the trade was built on a false premise. Now consider the break of an area. Trapped traders often become less interested in profit and more interested in escape. If price returns toward their average entry, some will use the opportunity to close with little damage. Their selling can restrain an upside recovery, their buying can restrain a downside recovery. The place that once attracted entries can therefore become crowded with exits. This creates a cause and effect chain. The market invalidates the breakout. Early exits push price farther against the remaining positions. The growing loss persuades more traders to leave. Their orders reinforce the adverse movement, which increases pressure on those still holding. A quiet positioning problem can become a directional force once exits begin to feed on one another.